Hi everybody, Frank Finance here. Hope you're having a wonderful day. Have you ever thought to yourself, okay, I have a 401k, I have an IRA, what do I put my money in? What do I invest in? Well, today we're going to attempt to answer that question with two simple investments that everyone can easily make. So for today's agenda, I'm going to tell you what those two investments are, a brief description of how they work. I'm going to go over things to consider when choosing which one is best for you. I'm going to go over some personal examples of what I have available inside of my retirement accounts because I almost guarantee it's going to look very similar to when you log into your personal accounts with your 401ks, your IRAs, etc. And then lastly, I'm going to give my final thoughts and recommendations on what you should do. So those two investments are index funds and target retirement date funds. Now for index funds, they're essentially a portfolio that's been constructed to match an index. So that index could be the S&P 500, Dow Jones, NASDAQ. They also are made to match segments of the market or industries. So you could have one that matches oil and gas. You could have it for technology, healthcare. Now particularly for retirement accounts, I would definitely highly recommend just sticking with an S&P 500 index fund and one that's low cost. Number two, we have target retirement date funds. Target retirement date funds are essentially a way for you to make an investment, and as time goes by, the risk is turned down the closer you get to retirement. So how does that work? When you first make an investment in a target retirement date, you'll go ahead and choose the year at which you plan to retire. Now, if that's 40 years in the future, that the mix of the portfolio is going to be more geared towards equities. And then towards the end of getting closer to retirement, it's going to be geared more towards bonds and fixed income, things that are generating dividends, income monthly. So it prepares you for retirement. Now, what that does is going from equities into fixed income and bonds. What that does is it takes your risk from, let's say, high. I'm not saying it's high risk investments, and it takes it down over time. So the closer you get to retirement, the less volatile your balance on your account will become, but also the less of a rate of return you should expect, because of the volatility will be down, but also the rate of return also goes down. All right, so let's talk about some things to consider when choosing between an index fund and a target retirement date fund. Now, you should always start with the end in mind. So you should always figure out when you plan to retire. That will help you make decisions on everything else we're going to cover. So moving into diversification, you should always consider how diverse your portfolio is and if it exposes you to additional risk. Now, when it comes to index funds, these are typically really all invested in equities. Now, an S&P index fund is going to be invested in the top 500 companies in the U.S., and that's where its diversification is. Now, it's diverse in the sense that it has 500 companies in the portfolio, and if one fails, it's not much of a risk to bring the whole index down with it. But on the other side, it's not diverse because it doesn't have anything like fixed income, bonds, small cap, things like that. And then when it comes into target retirement date funds, these are risk adjusted over time. So it depends on if you buy the fund closer to your date of retirement, it's going to be less risky. It's going to have more diversification in both equities and bonds. If you buy it farther away from the target retirement date, let's 40 years out, it's almost going to be 100% equity. So it's going to look a lot like an index fund. So that's why it's good from a diversification, because it kind of does that diversification for you over time. Now, the second thing is risk. Now, we've kind of touched on that. And your risk profile really just depends. It really just depends on you. And you really need to think about the first thing I always like to tell people when it comes to retirement accounts, you really shouldn't be planning on taking any of that money out until you actually go into retirement. Now, for Myself personally, I'm okay with being 100% in equities as long as the equities are diversified across the board. Like I'm not putting all my money into one particular stock. As long as I'm invested across a broad range of equities, I'm okay with that because I'm comfortable. I got a long time horizon for retirement, and I enjoy my job. So that's my risk profile, and so I'm completely comfortable with that. Now, when it comes to target retirement date funds, you can put the money in there. All that diversification and risk gets adjusted over time. Doesn't mean it's exactly your risk profile because you don't have any control over when that dial gets cranked up or cranked down, right? Well, it always gets cranked up. Less risk over time. And then the third thing I want to talk about is fees. Now, one thing you'll notice as we go further into this, typically index funds will be less because there's no risk adjustment over time. There's no one monitoring the fund. It's just mirroring the index. So there's not a lot of fees, and over time, the cost of index funds is just almost to zero in some cases. And so just from a fee perspective, index funds has the upper leg here, and we'll show you that later. And then lastly, just consider your type of retirement account you got, whether it's employer sponsored or an IRA. In employer sponsored, sometimes you don't have a choice for a target retirement date fund. You only have indexes. If you have an IRA, you pretty much have access to anything. You can buy individual stocks, you can buy indexes, ETFs, mutual funds, you name it, you can invest in it. It just depends on the brokerage, but more than likely you have access to probably hundreds of index funds, hundreds of target retirement dates funds. All right, so for the first personal example I can give you, I have an account that has 28 options in it. On the left side, you'll see the target retirement dates. On the other side, the right side, you'll see the other funds, which have the indexes in them. Looking back at the target retirement date funds, now you can look at these, you can figure out, okay, well, I want to retire in 40 years. Okay, well, I want the 2060 State Street TR 2060 fund, and you can see what the gross expense ratio is on that, and you can make your consideration. So notice that that's 0.89%. So that's, just to think 1 to 2% is actively managed, typically. Now, on the other side of the house, we have some index funds. You can see that we have most of my money, 80% is in the Fidelity 500 index. That expense ratio is 0.015%. So 1% of 1%. Okay. And then the Fidelity Contra K6, this is a little bit, not a ton of active managed, but it's a little bit where they're making some more moves than you typically would see in an index fund. So that's not really an index all that much. And then you have the Vanguard Emerging Market Stocks Index Admiral Shares. Now, this is an index, but these is for emerging markets. So this is where I'm getting some diversification in non-U.S. equities. And you can see that it's a pretty low expense ratio when you compare it to an emerging markets index expenses at 0.14%. Moving on to example number 2, we have another account that I have. And you can see that there's only 15 options in this retirement account. Now, this one's broken up a little bit different than the other ones. You'll see there's long-term bonds, large cap, small/mid cap stocks, and then international stocks. Now, the way I've chosen to do this is I put 55% of my money into the Vanguard Institutional Index. You can see that its net expense is 0.02. A little bit higher than the Fidelity 500 in the previous example. For the small/mid, I got a Vanguard Mid Cap Value Index Admiral Shares. And again, just because it's small/mid cap, the expense ratio is a little bit higher, but still extremely low at 0.07%. And then lastly, I have another 20% allocation in international. emerging markets. And those expense ratios are considerably higher at 0.4, 1, and 0.4%. Now, that's how I do my diversification inside of these accounts. Again, you'll notice that I don't have any money in bonds. That's personally how I don't do that, at least at this stage of my life. Another thing you'll notice in this particular retirement account, there are no target retirement date funds. So you don't even have that option if you wanted it. So if you wanted to just depending on where your risk profile were, you would probably have to diversify your account on your own. That's basically what I've done by buying different funds. I know, these large cap are fairly stable. They just go with the market. The small/mid cap stocks, they're a little bit more volatile. So as if large cap goes up, then small/mid cap could go up a little slighter or more volatile. It just depends on what stage of the economic cycle we're in. And then international stocks, these have actually done poorly in the last, 10 years in comparison to US stocks. But again, I want that diversification just in case I need it. And so that's why I have that allocation. So now you've seen a couple examples of index funds and target retirement dates actually in retirement accounts. Now, these both examples were 403Bs because of the type of employers that were sponsoring them. But the same thing applies for 401ks, 403Bs, 457s, and IRAs. I have a video on explaining what those different types of accounts, as well as Roth versus traditional. I'll link that in the comments below. But going back to the whole purpose of index versus target retirement date. Now you can probably tell by the examples that I personally lean towards index funds. I like to have a lot of control over my accounts, and I like making changes personally. Now, I think there's a lot of merit to target retirement date funds because they allow people to invest in a single fund. They know when their retirement date is, they invest in it, and they don't have to think about it again. Again, remember, when it comes to retirement, there's really three things that are really important. You have time, you have your allocation of how much you're investing month to month, and then you have dedication. So you need to be doing it consistently, you have to be putting money in every month, and you have to, it's as simple as that. So just get started, put the money into the accounts, choose an investment, and start saving for retirement. Well, look at that. The video's over and I haven't even asked you to subscribe, like, or comment yet. So please do me a favor and choose one and just do it. Thank you so much for watching today's video. I really appreciate all the support thus far. Love each and every one of you. Thank you so much from the bottom of my heart. Frank Finance, out.